All right, so this chapter's kind of organized into 5 or 6 parts, right? And I think that was last Wednesday. We talked about things like standard of living. Remember what that is? You have a sense of it, I'm sure,
Yeah.
right?
It basically is how much does it cost for you to live how you want to live.
Well, that's the cost of living, right? But your standard of living is well, it's like what you consider necessities, comforts, luxuries, right? Okay. Some people, require a really nice Cadillac to drive around. Others just drive an old Dodge, and that's fine with them, right? Okay. And what would you say would be the key determinant in your standard of living, other than your mindset about
Your
it?
income?
Yeah, your income, right? Your wealth, how much wealth you have. Real wealth is?
Yeah.
What's wealth?
Well,
Huh? Meaning what? Because I know, like, you're worth a lot to your mother, right? I mean, parents will train for you because, well, maybe that.
how much money your assets? How much money you have, like assets?
Well, it's a net assets, right? What do I mean by net?
That means like stock or.
Well, there's gross and there's net, right? You'd agree that the gross value of your assets is just actually the value of everything added up, right? What does that mean by net? What might you subtract from that?
Taxes.
What's that, Rick? You're getting closer. How do you acquire certain assets like cars and houses? Usually.
By taking loans.
Okay, now we're getting there, right?
Yeah, I mean, it's like.
And all these loans are known as what?
The net income is minus all the taxes, all the annual spending of like taxes.
Well, your debt, not necessarily your taxes, right? How much debt are you in? Like how much is left on your car loan? How much is left to be paid on your mortgage, right? So your wealth, your net worth, is the value of all your assets minus the sum of all your debts, okay? So let's see, then he talked about current needs and the average propensity to consume. If you remember, that's the percent of each dollar you spend as compared to each dollar saved, right? And there's a simple little percent formula, right? We usually do it on an annual basis, okay? Annual spending divided by annual income times 100, right? So if you earn $100,000 a year, and let's say you save 10% of that, what's your average propensity to consume? 90%, right? Everybody agree with that? Pretty simple. So before we can think about planning, right, we need to think about our current needs, how much we generally spend right now, future needs. Someday you're going to want to retire. Someday, well, you guys right now probably might need some money for college. And someday you'll have children that will need money for college. And you'll need to think about those future needs, okay? Maybe you want to plan on buying a car, taking a vacation, right? We'll have a plan for an emergency, right? Did we talk about an emergency fund?
Yeah, I'm like shock costs.
Yeah, you should. It's a real good idea if you can to, from all your income, to save up enough for 6 months of living without a job, right? Maybe you get laid off, you get fired, something like that. Maybe a disaster happens. You get injured and can't work, right? Okay, so you should have a little set aside an emergency fund. And we already talked about wealth. And we had a discussion about wealth versus cash last Wednesday, right? Anybody remember the gist of that?
Wealth is like your assets and all that stuff combined, while cash is like all the money you have.
Cash is a subset of wealth, wouldn't you say? Wouldn't you say if you have cash in a checking account, it's one of your assets, yeah? But would you say, if somebody tells you that Bill Gates is worth $5 billion, a lot of people think, well, that's how much cash he has, right? And the government only prints so much cash, and so he's got $5 billion of those dollars, and that means I can't have them, right? Do you think that's the accurate way to think of it?
No.
No, why not?
It's $5 billion more the wealth his assets accumulate.
Right, they're tied up in assets that are not necessarily cash, right?
Yeah.
Like property, plant, and equipment for the business. These assets actually generate income, don't they? They generate revenue. Okay, so it's not all just cash. So just because someone is wealthy, it has nothing to do with whether you can become wealthy or not, right? It's not a zero-sum game, as they say. There's two types of assets generally, right? Financial or earning assets. Those will be your investments, you know, your savings account, money market fund, stocks, bonds, your portfolio, right? Your retirement fund, IRA, that kind of thing, which we'll get into a little more detail later on. Then the tangible assets, you know, like your house, your car, that kind of thing, your game consoles and whatnot, jewelry. Anybody have any art? Someone's into art, right? Okay, so once you've thought about your current and future needs, then you can start thinking about your financial planning, right? And on page 7, you recall, there were 6 steps. I kind of summarized them here, right? So you want to define your goals. What do you want to do? There's basically 3 categories of goals. Anybody remember what they are?
Short-term goal, intermediate goal, and long-term goal.
Short-term, intermediate, long-term. Short-term would be less than a year, right? Intermediate might be out to, what, 5 years?
2 to 5 years.
Yeah. I don't like how they said that. That's kind of weird, right? So you have these goals that the short-term go up to 1 year, and then the other ones start at a full 2 year. What about the between 1 and 2? I would revise that and say 1 to 5. I don't know. It just seemed like they overlooked something. But anyway. All right. And once you define these goals, right, you make some plans. Okay? You jot them down. And your goals, remember, they should be kind of specific, right? Especially like the short-term goals. Okay, I want to be able to save money over the next year. Do you think that's specific enough, or should you whittle it down a little more?
Like you should say, I want to save up to like $10,000.
Yeah, or maybe some percent of my salary, right? Might be even more useful. Okay, I want to stick away. Then once you make your plans, you implement your plans, right? You put them to work, start saving, right? Start putting away for down payment on the car or whatever. And the best way to do that is to make a budget, right? We didn't get to talk. Did we talk about budgets last week?
Yes.
So a budget just is kind of like the roadmap you're planning, you say. It tells you how you're going to get there. How much are you going to spend on this category? How much are you going to save for this goal? That kind of thing. And you're going to use some word called financial statements to evaluate, right? Over time, you want to go back and look at your plans and goals and look at your financial statements, which we'll get into more in chapter 2, okay? There's generally a balance sheet and an income and expense statement, okay? That'll tell you where you stand. Are you reaching your goals, okay? Do I have the wealth I want? Right? Is my income and savings where I want it to be, okay? So you'll use these statements to see how you're doing with your goals and plans. And then you always want to look at revising them, right? You don't want to make your financial plan right before you start going to college and maintain that plan until you retire. Does that make sense? Because things are going to change, aren't they? Okay. And there are some terms in there they used, right? Utility, that's how much satisfaction you get from a good or service, right? That's kind of an amorphous term, right? It's going to be different for everybody. The psychology of money, everyone has their own like hierarchy of values, right? How important is money to you? Some people, it's not all that important. You know, some people like, yeah, I just give everything I earn away to charity, except for, you know, enough to buy food, clothing, and shelter, okay? Money and family, right? At some point, maybe you guys are going to have a family with a couple little crumb crunchers running around there, and they're going to want money. And it can lead to some big, you know, brouhahas, arguments, disputes, spats, right? Probably one of the most common sources of disagreement in any family. And so you should always be, you know, communicate clearly what your goals, plans, and budgets are, right? Your rotten little kid needs $50 to go do this thing, you know, you say, hey, you know, here's the budget. I don't think so, right? And look at your own $50. Money and friends, I would say it's generally inadvisable to lend to or borrow from your friends. Do we think about why that might be?
Because that's a now you owe that money.
Yeah, and what if your friend doesn't pay you back? What's the general feeling in that relationship?
That they don't really want to pay you back.
Yeah, well, how about maybe a little animosity kind of thing?
Distrust.
Distrust, sure, you won't be able to trust your friends, yeah, okay? So it's generally not a good idea to do financial dealings with your friends. A little bit like, hey, this little McDonald's, this one's on you kind of thing. Where was I? Let's see. We already kind of talked about the goals, right, being specific. And you might notice on these notes, I broke it up into day 1, day 2, day 3, what sections, right? So maybe this is officially day 2, turning the goals into plans, right? Part of that 6-step process. I think that starts on page, let's see, 1, 3. Page 11. Okay. So plans and then your budget's like a roadmap to your goals kind of thing, right? And your plans have a life cycle. We touched on that a minute ago, right? Because don't things change over time? Your situation changes. What else might change?
The environment.
The economic environment around you, right? There might be a tax increase or tax decrease, right? That interest rates might go up, which makes the cost of buying that car a lot higher, that house a lot higher, right? And so what do you have to do?
You have to change your budget.
Go back and review your goals and your plans and your budget, right? And adjust accordingly, okay? So every few months, you definitely want to go back and look at that. We talked about an emergency fund, right? Because there could be financial shocks, as they call them, okay? You lose your job, you get into an accident, death, divorce, illness, all that kind of thing, right? Anybody think of anything else that might happen that you might need an emergency fund for?
You lost your car.
Lost your what?
You lost your car.
Car, okay. Well, I would hope, though, the emergency fund for that might take the form of automobile insurance. So you might not need a fund for that if you're fully insured. We'll talk about insurance in just a minute. But if you take a look on page 14, there's a graph of the personal financial planning life cycle. Let's just take a look at that real quick. Let's get a sense of it here. Well, what do I do with it? Let's see. There we go. That's not it. Yeah. Okay. Look. Again. Car, of course. 1, 3, the life cycle. Maybe that graph can be here. Oh, there it is. No, that's not it. Yeah, it is. All right. And you can see that in your book a little better, maybe, right? Take a look here early in life, right? What are you doing? What's this first thing here that you're doing when you're young?
You know, increase in your house.
Yeah, wealth accumulation, right? You're buying those cars, houses, and whatnot, right? Right. You're using your plan and your budget, right, to reach these goals and accumulate your assets and whatnot. Okay, and then you get to where you're nearing retirement, right? And you want to think about preserving these assets, preserving that wealth. And then after you retire, well, maybe you're thinking about when you're going to die soon, right? And so what do you want to do with all those assets, maybe?
Liquidate them.
Okay, your kids will appreciate that. Well, what might they appreciate more?
Giving it to you, giving them some back.
Yeah, pass it on, right? So wealth transfer. Yeah, he's all right, kids, sorry, no, but when I go, I'm liquidating everything. Okay? All the money's going to my favorite charity. Oh, that's awesome, Dad. We love you. Right? Okay. So this is basically the gist of it. When you're younger, you're trying to accumulate wealth. You get middle age, you try to preserve it, and then you try to give it away when you get older, or or spend it all, right? My grandmother used to have a bumper sticker that said, I'm spending my children's inheritance, something like that. The implication was, it's gonna be all gone. Then that happens. Okay. So, then the book talks about achieving goals, right? Your asset acquisition, right? Cash, savings, investment, personal property, real estate, and then the liabilities that generally go along with that. Those are the debts that you incur to finance or purchase these assets. Very, very few people can purchase a home or a car without, a loan or a mortgage to go along with that, right? So let's say you're looking at, might be a moderate home, $150,000 in this area is, not too uncommon. How many people do you think have that in their bank account right now? Is that a zero? Hey guys, remember the 20% participation rate? Don't forget that. So participate. All right, Oscar, how many people do you think have 150,000 here in Waverly in their bank to just go out and buy their next house?
Not many.
That's unreal. 10, you think?
5%.
I need to start hanging out with the people you hang out with then. 10%, you think?
The 1%.
Maybe 1%. Maybe. Just a quick story. I told you I used to be a loan officer at a bank, and which means that people come in and apply for car loans and mortgages and whatnot, and I had to review their situation, approve it or deny the loan or modify it or that kind of thing, put together the terms and everything. And there's an old guy that came in and he never borrowed any money in his life. The guy he was really wealthy, really rich, but he had a real, I would say, modest standard of living. Okay, he was the kind of guy that had a lot of wealth, but he drove, an old 80s Chrysler sedan, and didn't really spend it right, didn't borrow money. He had purchased, I think 2 or 3 homes on his own cash, okay? He saved up the cash and bought it all, there's a briefcase full of cash for this house, basically, right? But then I guess he ran into a situation where I think his daughter needed some help buying a house and he wanted to take out a mortgage. Now, the guy had never borrowed any money, right? But he was voted and he was a well-respected member of the community. And I took a look at it, looking into your credit reports later on, I took a look at his credit report, and his credit score was horrible. I mean, it was like 400 something, which is horribly low, because he had no credit history at all. Okay, and so based on that, by the numbers, that the bank would approve things, I couldn't give him the mortgage. But nice, was like a local bank, so I went to my branch manager, and branch manager knew this guy, and he had the discretion to go ahead and give him the mortgage, so it worked out. Like another bank, like another national type of bank, probably wouldn't be able to do that. Okay, so establishing your credit is actually kind of important too. So we'll talk about that later on. Now the insurance, right? We were talking about a minute ago about having an emergency fund. And I guess you could consider insurance part of that because you pay insurance premiums each month. What type of things do you think you might want to insure, would you say? Vehicles, house, right? What? Yeah, your health, definitely. Yep. Who's going to pay the doctor in the hospital, right? That stuff gets pretty expensive.
Your life insurance.
Life insurance, yep. You want to have life insurance. And make sure that your spouse isn't the one working on the brakes in your car. Okay. But basically, you can insure anything you like. I mean, everybody heard of Lloyd's of London? That's a giant insurance agency out in England, and they generally insure things for the super rich, like TV stars and movie stars and whatnot. There are some people that actually they insure their legs. I think it was Mary Hart. She used to have became a talk show. She was famous for her legs on the show, whatever. But she insured her legs for something like $50 million. case like she got into a car accident and that thing that, you know, I guess she thought made her income wasn't there anymore, and she's covered. Probably wouldn't have thought about that, but yeah. But generally, you guys are going to think of insuring all your assets. Generally, the lower price ones, not so much. Homeowners insurance, right? Hurricane comes through, tree falls on your house, that kind of thing. And a lot of times, homeowner insurance will cover the contents of your house, right? When you get a homeowner's insurance policy, you will list like the value or some estimate of the assets you have in there, like your television, your stereo, your electronics, right? Your furniture, your appliances, that kind of thing, anything that might get destroyed, right? So those things can be covered under homeowners. Your automobile insurance, you not only want insurance that covers damage that you do to someone else or someone else's property, but you're also going to want to have insurance for damage that happens to your vehicle. Right? Now, a lot of young people will not get that side of it, right? They'll just do the bare legal minimum, right? They'll have insurance for damage that they cause to someone else, right? You're not allowed to drive without at least that, right? Because if you hurt somebody or damage something, somebody's got to pay for it. But you certainly, and we'll get into insurance later, want to talk about, you know, think about getting collision and comprehensive insurance to protect yourself. Okay, so investments, right? So investments are basically spending money to make money, yeah? Right? You purchase something with the hopes that what will happen?
That you gain money.
Instead of what?
That you're getting overall more money.
Yeah, right? You expect what's called a return on that investment, okay? Whether it's something as simple as just a savings. Anyone ever have a savings account with a bank? Okay. And you usually once every month, do you get it? Maybe you don't even get a statement in the mail anymore, but you get a statement telling you what happened. They pay you interest. They pay you money to keep your money in the bank. Why do they do that? Right now?
To encourage you to actually put money into the bank.
Why do they want you to put money in the bank? What's it to them? What's the difference to them?
Because they have more.
They what?
Because they make more by how much.
Well, how do they make more if you put more money in the bank?
So they can give it to other people.
Give it?
They can loan it out.
Loan it. There you go. Okay. So when you go to the bank to get a car loan, they lend you money. That money is from other people's accounts, right? And so they encourage people to keep their money there, right, at a certain interest rate. And then they loan the money out at a slightly higher interest rate, okay? And it's called a bid-ask spread, right? The interest rate spread where they can make their profits on, right? And so like a savings account, does anybody know the difference between like the access to your funds between a checking and a savings account? So you guys have savings, maybe you have a checking account too with it?
No.
Okay, so if you do, right, a checking account, you have complete, total, unlimited access to your money. Okay, you can write a check or go to the ATM or down to the bank and withdraw it all multiple times a day if you want, right, at any time. And so the difference between that and the savings account is maybe you notice in your savings account, you're only allowed to make usually, I don't know, like 6 withdrawals per month. So it's a little more limited, right? Now, generally you don't earn interest on a checking, but you do earn a little bit on a savings. Can you think about why that would be? Based on what we just talked about?
Because the savings account, so that you gain some sort of interest.
Well, with the restrictions on withdrawals, it's more likely that your money will remain there, yes?
Yeah.
Okay, does that make sense? And they're more certain of having that money available to lend to someone else. And then there's other accounts where it's even more certain that your money will be there. Anybody here, let's say a certificate of deposit, CD? Well, that's where you put your money into a certificate of deposit for anywhere from 6 months to 1 year to 2 years to 5 years, right? And you can't touch it for that entire time. And so they generally pay more interest than would a savings, okay? Because they're assured that money will be there. So they're ensuring that your money will be there for them to work with. And the payoff to you is a higher interest rate, okay? So it's like win-win for everybody, yeah? Okay, now also, with these returns, you want to consider the risk, okay? In a savings account, would you say there's a lot of risk of losing your money or not much?
Not much.
Not much, right? And so the interest rate is kind of low, yes? Let's say, we haven't talked about corporate bonds yet, have we?
No, I think we did. We talked about stock.
Well, corporate bond is like basically you're lending the company money, all right? They're actually taking a loan from you that's payable, you know, in 5 years or something. They'll pay you back with interest. But they're going to be a little bit more risky than a bank savings account would be. Would you agree? Company could go bankrupt, fail, right? Go under, competitive environment, yeah. And so what would you say about the interest rates for, say, a corporate bond as compared to a savings account?
Being more interest.
It'd be higher, right? So the higher the risk, the higher the expected return you should demand. That makes sense. Okay? If you're taking more risk, well, you want to get compensated for that. Right? And generally, you want to look for a higher interest rate and keep things in the investment for a longer term, also known as a horizon, right? We talk about the CD, right? A 1-year CD, they would say has a horizon of 1 year, okay? Your retirement fund, if you were to start one at, say, age 20 and want to retire at 65, right? What would be the horizon for your retirement fund? 20, want to retire at 65.
45.
I was going to say, you guys are pretty good math students, right? Okay. So that's a 45-year horizon, okay? That's the idea. Anybody remember this formula, compound interest?
Yeah.
Yeah? No?
Yes.
No? Casper, stop it. You just can't have nodded your head no. You were awash in it last semester. You were up to your something in it last semester. Compound interest. All right, he's monkeying with me, okay? And notice where the variables are up here. The T for time.
Yep.
What kind of function is compound interest?
Compound interest is for the exponential gain.
It's an exponential function, right? Remember they do this, right? You start out slowly and then you compound the interest and it starts to grow much more quickly, okay? It's nice to have your money act exponentially. That's always nice. And if you take a look at about page 15, they have a sketch of something. Where is it? Here. And this doesn't have page numbers for me, so I just have to go. Tell me when I get to page 15. Am I there? No. I want that graph. Next one.
Next one.
Oh, wait. What was that? No.
Next one.
Okay. Probably. So this thing, it breaks up some of the pages in one page into 2 or 3. So it's like this whole back to like back in the
Yeah, you need to go
threes.
back.
I gotta go way back. 1 3s. 4. There. Back. Listen to you, Antonio. There it is. Right, that's what I was looking for at 1.5. Okay. Notice this doesn't start. It starts at 1,000, right? So basically, you're putting money in the bank here for 40 years, and the value of investment obviously grows, right?
And the weight of the more changes.
Yeah. Now look at this rate of return here. It's 4%. Okay, and this one is 6%. Is that a 2% increase?
Yeah.
You sure?
No, really. No.
To go from 4% to 6%, is that an increase of 2%?
No.
Isn't that an increase of 50%?
Yes.
What do you have to add to 4 to get to 6? 2. What's half of 4? 2. So it's a 50% increase. Now, it's you would correctly stated as an increase of 2 points, right? But it's really a 50% increase, okay? So those 2 points, look at the difference over this horizon. What you'll have is the value of your portfolio. 4%, we got what, 4,800? 6%, you're over 10,000. So it makes a big difference. The rate of return and the time horizon make an enormous difference, right, in the final value of your portfolio. So keep that in mind. So what does that tell you, by the way, when you want to set up your retirement?
The greater the rate is, the better you get, better return.
And what else?
The longer it is, the more money you gain.
So you should begin saving for retirement when?
The fact, sooner than thought.
As early as you can, right? Right? The longer you can start putting that money away and getting that compound interest, the better off you will be. Okay? There's other things to take into consideration. Employee benefits. Most of the time, people get their health insurance through their employer, their pension, profit sharing, right? So here's some retirement things that come into play. If anybody here with a 401k plan, that's a popular type of retirement plan. We'll get into that some other chapters. Tax planning, right? The amount you pay in taxes. Yeah. Sometimes, it's 30-40% of your income. And your duty to yourself is to minimize that tax liability each year if you can, right? And there's ways to go about doing that, different write-offs and things like that. And there's a difference between tax avoidance and tax evasion. Any thoughts on that?
Avoidance is not intentionally.
Oh, it's intentional.
Oh.
Yeah, it's definitely intentional, but it's not illegal. If you can legally, using the current tax laws that exist, reduce your tax liability, do so. Right?
Well, evasion is illegal.
Now, tax evasion, that would be something where you omit a big chunk of your income, right? You don't list it, and so it doesn't get that kind of thing, right? Now, that can get you in trouble, right? But if you can be truthful and avoid as much tax liability as you can, and that's fine. That's your duty to yourself to do that, right? Because if you're not doing that, you might as well just say, okay, I'll just pay more tax because I feel like it, right? Here, Mr. Federal Government, I will hand you another $10,000 because I'm a nice guy. Would anybody do that? I wouldn't do that, man. Somebody would. Okay? And then retirement and estate planning. Again, we talked about starting that early in life. So some special planning concerns they talk about in the book, right? Changes, surprises in life, changes in the economy. What kind of changes in the economy might affect your plans? Because you're trying to plan while all this stuff is happening and changing, right? What kind of changes?
Unemployment.
Well, what's been happening over the last couple of years?
Inflation.
Huh? Well, not over the last couple of years, over the last 6 to 8 months or so. But what about like pandemics? Can that affect the economy?
Yes.
Right? Businesses shut down, right? Unemployment goes through, maybe you lose your job. And so that brings down the supply of things, wouldn't you agree? Which means that the price of things does what? It goes up, right? I will tell you that, so man, that summer after the COVID thing hit, I was about to, I needed to rebuild my back deck. And so normally you go down to Lowe's and just 8-foot 2x4s used to be like $2.15 a board. And I went down, that was 2 summers ago, and I went down to Lowe's and took a look at their 2x4s. They were over $8. Right? So it's almost like 4 times the cost. And, if you're building a deck or something, you're going to need a lot of those, aren't you? Okay, so I decided to hold off. All right, so there I changed my plans. Okay, taxes may be going up, right? Interest rates might be going up, and we'll get into why that can happen, right? If the more government regulation, Economic downturns. If you are, let's say, putting $500 a month into, say, your retirement fund or your kid's college fund, and let me ask you a question, because we have this term here that's not in the book. So let's say you've heard of GDP, yeah? Gross domestic product, that's how we measure our economic output generally in the country. Okay? And it kind of, let's see, this is the GDP, and this is time. Right? So maybe, you know, our economy's doing this, and then all of a sudden it just goes down like this, right? Maybe it's going to come back up, right? When we hit a downturn like this, should you stop investing in your portfolio because of losses? I mean, because your portfolio is going to take a loss, right?
Shouldn't you just buy it?
You should, especially if you're in it for long-term horizon, right? Why would you want to keep buying?
Because
Here.
it costs less.
Dollar cost averaging, it's called, right? So you can keep purchasing these equities and investments and put in your portfolio, but they are coming at a much lower price, right? And so you can purchase more of them, yes, with the same amount of money. And then what happens?
No,
These that you purchased in here, more than you normally would have, when the economy rebounds, and it almost always does, right, over any 10-year period, it definitely always does, without fail, goes back up. So you now have more securities that you put in your portfolio, right? Not only do you have more, they now have a much higher return because they started so much lower, right? Does that make sense? So unless you're like a day trader who's living and dying, you know, by trades at the end of each business day, then that's really risky and stressful, right? If you're just investing for the long term, you keep on buying. Dollar cost average these dips, okay? Stick with it. So, planning environment. So we talk about being prepared for interest rate changes, tax changes, inflation. We know what inflation is, yeah? What's inflation?
increase cost.
Costs generally go up over time, right? Anybody here, your grandparents talk about, remember, you know, a gallon of gas used to cost 30 cents? And they kind of lament the fact that, okay, that sounds great, but what do you think the average monthly income was back then?
A lot less.
50 cents. I don't exaggerate, right? A lot less, right? So like dollar for dollar, it didn't really matter, right? So inflation's not really a problem if wages are going up with it, right? Okay, if you're getting, you know, if inflation is say at 3% and you're getting a 3% cost of living adjustment each year, you're fine, okay? But this is a little different. Stagflation is called. Anybody hear that term?
Yeah.
What's stagflation then?
Basically, the wages stay the same.
Yep.
But the inflation, but the cost.
Price of everything goes up. And we're kind of flirting with that right now, right? Inflation generally runs around 3% per year annually, historically. Right now, does anybody know what percent inflation is at the moment? Like 7.
Oh.
7. So if you're getting a 3% cost of living increase and inflation is going up 7%, is that working for you?
No, you have to change your plan.
You're actually getting a 4% knock, aren't you? Right? When you factor in inflation. Inflation's a big thing to consider, especially when you're investing, right? You want to, your investments, at some point we'll take a look at it, should do with an inflation adjusted return. So if your investment is returning 10% and inflation over that time period averages at 3, what's your investment actually returning? Not 10, but what? 7, right? Okay. Oh, shortages we talked about, right? We've been going through a lot of that. Go to the grocery stores now, right? How many times you guys don't grocery shop, do you?
I see them, and mostly
Empty shelf. Everybody working at like Walmart or something, a grocery store? A lot of shelves are empty, man. You go in there, they got nothing left. So the players they list, right? 3 main ones, right? The government, who can affect the economy through taxes and regulation, also spending, by the way. Businesses, they're in a competitive environment, always battling with one another. There's foreign threats to consider, right? Back in the 80s, the foreign economic threat was Japan, right? Japanese automobiles almost crushed our car industry.
Yeah, now it's China.
Right? Now it's China doing the same thing, right? The labor market, right? Unemployment rate, supply and demand generally puts pressures on the economy. So all that comes into play when you're making your plans. And then we, the central part, the consumers, right? We're in charge of spending and saving decisions. And we need to make all these decisions, right? In the midst of, government and business doing what they do. Then generally the economy. So we have federal and local government, what's called fiscal policy. You've heard that term? Okay. That's the taxes, regulation, wage policy, right? Sometimes they like to say increase minimum wage, that kind of thing. That's a discussion we can have one day. Spending, supply and demand, right? The more there is of something, what would you say happens to the value of it?
It decreases.
And the less, or vice versa, right? Okay. So when the government spends, they're putting more cash, actual cash out into the economy, right? So what would you say that does to the value of a dollar?
It increases.
That's called inflation, by the way. When the value of the dollar decreases. And one big way it can decrease is if the government spends too much, right? If they're flooding. Okay, so the value of each dollar is less because there's more out there, right? And in general, when they decrease taxes and regulation on business, that stimulates the economy, okay? And then increasing taxes and regulation generally tends to choke the economy. And there's a famous economist by the name of Art Laffer. Has anybody heard of Art Laffer?
No, I don't think so.
Okay, he was actually Ronald Reagan's economic advisor back in the 80s, and he did some work in the 70s. And he developed what's called the Laffer curve regarding taxes in the economy, right? And the revenue that the government gets. I'll just make a quick sketch of it here. Let me find a spot here. It won't be on a test or anything, but so let me make a graph. And this axis will be tax percent. And this axis will be government revenues going to the government from those taxes, right? So would you all agree that at a 0% tax rate, the government gets no revenue? They have no taxes, okay? Would you also agree that if they tax everything at 100%, would they get any revenue?
No.
Well, where will the revenue come from? Let's say you own a business, and every penny that you earn in that business, 100% of it goes to the federal government. How long would you be in business? Why would you be in business? Would you just say, what am I doing this for? So at 100%, the revenues to the government would approach or be right at zero as well, right? Because it basically shuts it. The whole reason for going into business is the profit motive, right? And if they're taking all that, why am I bothering, right? So somewhere in here, and this is just a rough sketch, as they increase taxes, revenue goes up, right? But as they keep going higher and higher and higher, it doesn't quite go up as much. And they keep going, then okay, there's less economic productivity going on, right? Because they can't people won't have profits to reinvest back into the business, right? And they decide, I don't even want to be in business anymore. Does that make sense? Okay. So somewhere in here is kind of like the sweet spot to maximize revenues. Okay. And we are currently like past that sweet spot, or were, right? And then we had a tax cut a couple of years ago, a major tax cut. And every time that tax cuts happen, right, the revenue to the government actually goes up. Why would that be? They cut taxes. But revenues to the government went up.
Because more people are getting more money.
Right. The more business and productivity takes place, right? It's not being, confiscated, right? And so businesses can take those profits and reinvest them into new property, plant, and equipment and hire people, yeah? That make sense? And so I don't know when the last time was we were on this part of the graph where we can increase and still get more revenue. As it turns out, we are generally on this side of it, and I'm way, I mean, maybe it's not out here like 75%, right? We're generally on this side of it, and when we cut taxes, right, we get more and more revenue. Because we're generally on that far side of the curve there, okay? So like a lot of time, like these days, we hear, you know, politicians say, well, we need to raise taxes to get more government revenue. In the very short term, it probably will bring more revenue in, but when the effects on the business environment take effect from that, then they get less. Does that make sense?
So you said this group said that he's the goal of the taxes.
Right, which we did like, was it 3 years ago, I think we did, right? And it was the best thing to do right in the middle of this whole COVID thing, and it really did help kind of maintain and spur the economic environment. And then there's the Federal Reserve. Anybody ever heard of the Federal Reserve?
It's the amount of money they have.
Not exactly. So Federal Reserve was an institution put into place right after the Great Depression to kind of help keep banks solvent. Remember how banks loan out your money?
Yeah.
Right? Back before there were regulations on how much they could loan, so banks would have a certain amount of deposits, and before these laws were enacted, they were free to loan every last penny of that and not have any, you know, not have much in the bank. So when people panicked and had to run on the banks and wanted to get the money the heck out of there, it wasn't there. Right? So now the Federal Reserve and the act that created it requires banks to have what's called a required reserve. And I don't know if it's like 15 or 20% of their total deposits they have to keep actually physically on site for people to withdraw it, right? And they also have a system whereby if banks are above that required reserve, they can take that money and loan it to the Federal Reserve, and then another bank who's under can borrow it back from the Federal Reserve. It's called the overnight lending, right, to keep their required reserve in line. And they charge an interest rate, right? And maybe you've heard about the Fed raising or lowering the federal funds rate for the last, I want to say 3 or 4 years. It's been at 0. Okay, so in other words, they're saying that money has no value, basically, okay, for the overnight rate. But when they start raising that Federal Reserve rate, right, the banks have to pay more interest to get that money to keep their reserves. And so what do you think that does to the interest rates that they charge people when they borrow? If they have to pay more, right, then they have to make that up and charge you more, right? So when the Fed raises lower rates, that has an indirect effect on the rates that you pay to buy your assets, right? To take out that mortgage, that kind of thing. Quantitative easing, I don't want to get too deep into that, but that's where the Federal Reserve repurchases government bonds, right, before they mature, to get more cash out into the money supply. And again, what happens when there's more dollars out there with the value of the dollar? Decreases. And didn't I just say that the interest rates that the Fed charges is 0? Does that indicate a decrease in the value of the dollar?
No.
Yeah, 0 as compared to 3, right? As is evidenced by the fact that they're flooding the economy with more money by purchasing back bonds before they mature. But that's kind of a side discussion. It's not in there. Right? Do you guys have any questions about any of this as we're going along? No, I'm rambling. Okay. And then we move on to economic cycles. GDP is what our economic productivity is measured by. That's a figure that usually comes out once a month, and it is an indication about how well our economy is growing. Generally, in this country, if we can get a 4 or 5% growth rate in GDP, we're doing pretty well. Okay. There are certain times where we have negative GDP rate. You ever heard of a recession?
Yeah. Okay.
That's when the growth rate in the gross domestic product is negative for 2 straight quarters. We consider that a recession. Okay? And that's not good. Okay. So the economy generally expands and contracts over time. It has cycle of expanding and contracting. Okay? Where's it? On page 21. Take a look on page 21. They have a simple graph of that, right? And they label it, you know, when GDP is growing, that's called an expansion. Then inevitably it's going to hit a peak, right? Almost looks like a sine curve, yeah? Right? And then what's it going to do? Contract, right? Let's see if I can find it here real quick. So I know I'm after this.
Next one.
Yeah, there. Okay, there we go. Okay. So we generally have expansions, peaks, contractions, troughs, right? And then back into expansion again. We're kind of on the heels of one of the longest expansions in the history of our country back in the mid 80s, generally with some minor ups and downs, right? Graphs always do this, right? But the general trend line has been expanding since the mid 1980s. And we looks like now we got the pandemic and all that. We're in a period of contraction again, right? And when we're in contraction again for 2 consecutive quarters as measured by GDP, that's called a recession. Okay, and these are things you need to think about when you're planning. Okay, you're planning your financial situation. Then inflation, we kind of talked about that already. That's a big thing to keep in mind, right? Tendency for price of goods and services to increase over time, which again is not a huge problem as long as what increases with it?
Your income.
Wages and salaries, right? And if they don't increase, we call that stagflation. Do you guys know how they measure, get an actual numerical measure of inflation? You could? No, it's just classic. It's called the Consumer Price Index, CPI, right? There's a bureau in the government that calculates the cost of several thousands of different goods and services over the course of a quarter in the country and compare it to
Previous one.
yeah, like the last quarter or last month or whatever, and they can tell you that they generate the Consumer Price Index, right? It's a percentage of costs going up generally, right? And if costs go up, your purchasing power does what?
Decrease.
Goes down, right? Okay, which is going to affect your planning, isn't it?
Yeah.
Okay, if you see inflation coming right now, man, right now 7%. Inflation of 7% hasn't happened since the early 80s. Okay, and that was a bad time. I was a kid then, late 70s, early 80s, and like right now, if you want to take out a mortgage for a home, interest rates are like around 3%. Back then, it was the interest rates for a mortgage for the same time period was like 18 to 20%.
Wait, what about 2008?
2008 was so yeah, we wouldn't call that a contraction so much, right? But that was the how I got a whole video. So that's kind of a fascinating thing. That is a fascinating economic downturn, right? But that was kind of like a blip in our contraction. We're coming back up out of that. They had a lot to do with the housing market. We'll get into that a little later. But I'll find some class time to talk about that. I think we have to get some other things in place first to help you understand that. But remind me, we'll talk about that 2008 mortgage crisis. Okay, and all of this affects the interest rates, right? When there's inflation, interest rates generally go up. Okay, which affects the cost of borrowing and your asset acquisition, and therefore your planning. All right, let's just cook through day 3 here. There's not much here, right? What kind of things would you say determine your level of income?
Your age, your martial status.
When would you say there's 2 points in your life that generally, obviously, there are exceptions, right? But when would you generally see the lowest income?
When you're young.
Right now,
Oh.
and after you've retired, right? Because maybe you have a pension or you have a retirement fund, right? But maybe you're only gonna have an income of like maybe 50-60% of what you were earning before that, right? Not necessarily a bad thing, because you're gonna think by that time that you retire, okay, hopefully you got your mortgage paid off, right? You got the kids through college, all that stuff is already taken care of, and you don't need that kind. You don't have to commute to work and buy gas, like you used to. Okay. Your marital status, right? You're married, your spouse has an income, so you basically doubled your income, and you build in some efficiencies, like if you weren't married, your income separately would have to pay for 2 different rents or mortgages or something, and not the one, right? So things get a bit more efficient. Generally, the higher your education, the more income potential you have. Generally, not always, right? I don't mean just college education, right? Vocational stuff too, yeah? Like, you guys know how much a good plumber earns? A crap ton, right? Know how much you can earn if you know how to, say, weld aluminum?
A lot.
A bigger crap ton, right? Because there's a few people that can do that, yeah?
Oh, so
Okay.
it's like the more unique your job is, the more money you make.
Sure, right? If you have a decent vocational education, not necessarily a 4-year degree, you can do very, very well for yourself, okay? Your location has a lot to do with your income. Here in this area, we're kind of rural, right? So compared to incomes in like New York City or Los Angeles, they're going to be lower, right? But what would you say offsets that? Mm-hmm. Well, yeah, that's right. That's what I was saying. So, like, if you're living in New York City, generally incomes on average are going to be higher.
But the taxes are going to be high. But
Well, the taxes, right? Would cost of living more, right? You know, like to buy the same thing in a metropolitan area that we can buy here for $3 might cost you $5 down there. Okay, so it kind of offsets a little bit, and of course your career or vocational choice. Okay, some of us have chosen a career with all sorts, piles and piles of education. I would say is an outlier to that data set, and we knows what I'm getting at. You know, teachers. Whole pile of things exactly rolling in it. But anyway, who cares? Just Mr. Hefner. He'll be fine. You locate, so we talked about that. So a little more details. Oh, networking, by the way. You want a career? Have you heard of the term networking?
Yeah, you gain friends or people.
The more people you know, right, the more likely you are to land something that you want or something you didn't even know was available to you. You know, I just got done with college. You know, hey, I got a buddy that owns a business. You know, such great. The more people you know, the more likely you are to come up with a decent career. Okay, networking. And that was that. So I think that covers the entire chapter. You guys have any questions? Just hurry over.
9:45.
Ah, look at that. Okay, we got a few minutes in. All right.